Hi, class. In this module, we look at a few of the methods and the schemes commonly used to commit fraud and the singles auditors and fraud examiners examine to help detect fraud. Let's begin. This chapter has 5 learning objectives. 1. Explain the various methods that Sensormatic and Xerox use to recognize future periods' sales in current periods. 2. Describe CUC's method of reporting fictitious revenue. 3. Describe Insignia's method of improper valuation of revenue. 4. Identify the singles in financial statements that could alert you to the possibility that a company may be overstating its revenues. And 5. Adjust for sales of accounts receivable in order to ensure that such sales do not dilute the singles that could alert you to an overstatement of sales. Sensormatic is presented mainly as an example of improper timing of revenue recognition via holding books open after the close of a reporting period. Sensormatic Electronics Corporation was a publicly traded company registered in Delaware with its head office located in Boca Raton, Florida. The company is still in existence but is no longer a public company. Sensormatic manufactures electronic security systems and is probably best known for its anti-shoplifting security devices. The company was known on Wall Street for meeting its budgeted figures for revenues and earnings. The company began facing enormous difficulty in meeting these phenomenal growth projections from at least the first quarter of its 1994 fiscal year. Despite this difficulty, Sensormatic's quarterly financial reports continued to meet analyst earnings forecasts almost to the cent. Sensormatic was removed from the New York Stock Exchange because fewer than 600,000 shares remained publicly held. According to the SEC, memoranda were prepared close to the end of each quarter, specifying sales goals that needed to be met before the close of the quarter. In order to comply with the aggressive sales budgets that had been published and distributed to senior management and to the various departments. In its proceedings against Sensormatic, the SEC examined the roles of a number of former senior executives of the company, including Ronald Asaf, former CEO, Michael Pardue, former COO and CFO, and Lawrence Simmons, former Vice President of Finance. Holding books open enables a company to report the next quarter's sales in the current period, but simply keeping the current period's books and records open for a few extra days after the close of a reporting period to record additional sales. This strategy was one of a variety of improper revenue recognition practices that Sensormatic allegedly used. Sensormatic used the ploy of shipping goods that customers had ordered for the next period to Sensormatic's own warehouses at the end of the current period to meet its quarterly sales budgets. Then, in the financial records, the company would recognize this revenue at the time of the shipment to its own warehouse. Sensormatic also accelerated its revenue recognition through a tactic of slow shipping or requesting the shipping company to delay the shipment of goods. Using the slow shipping strategy, the company could record a few extra days' sales in a particular quarter. When a sales order stipulates FOB destination, it means that there is a sales agreement specifying that ownership passes to the customer only when the purchased goods arrive at their destination. According to generally accepted accounting principles, The sale can be recognized only when the customer takes ownership. However, the SEC alleged that in the last week of some quarters, Sensormatic recognized some of its FOB destination sales at the time of shipping instead of the time the goods reached their destination. This was yet another of the variety of improper revenue recognition practices that the Commission alleged Sensormatic used in its attempt to meet analysts' quarterly revenue and earnings projections. According to the SEC, Sensormatic instructed employees to withhold certain bills of lading from the auditors because they would have indicated a practice of premature revenue recognition. If the next period's sales have been accelerated into the current period, or if the sales are completely fictitious, the company will debit accounts receivable and credit sales as for legitimate sales. However, while legitimate sales will be paid relatively soon by the customers and will turn into cash, the next period's sales will probably be paid only in the next period and will remain on the balance sheet in the current period as accounts receivable instead of turning into cash. When cash flow from operations lags or falls behind operating income or net income, it is a signal that the financial reports may not be correct. Xerox is presented mainly as an example of improper timing of revenue recognition via the misuse of multiple element contracts or bundled contracts. In the period from 1997 to 2000, Xerox paid its auditors, KPMG, the sum of $55.8 million for auditing its financial statements. The SEC found that Xerox accelerated recognition of its equipment revenue by more than $3 billion over the period 1997 through 2000 and increased pre-tax earnings by $1.5 billion. Xerox provides a dramatic illustration of fictitious reporting by improper timing of revenue recognition through the misuse of multiple element contracts or bundled contracts. Typically, Xerox customer leases generate revenue from three streams. The equipment net revenue, known at Xerox as the box revenue. This is the revenue earned by making the physical asset available to the customer. Should be recognized at the beginning of the lease. In sales type leases, revenue for servicing the equipment, this revenue should be recognized over the life of the lease. The financing of the revenue on the effective loans to the leases, this revenue should also be recognized over the life of the lease. The SEC found that Xerox shifted revenue in the following ways. Shifted revenue from its servicing revenue stream to the box revenue stream, making it appear as revenue received for physically transferring the equipment to the customer. This was done in order to recognize future service revenue at the beginning of the lease. Xerox's internal name for the accounting method whereby it shifted this revenue was return on equity method. Shifted certain portions of its financing revenue to the box or equipment revenue stream so as to recognize that revenue at the beginning of the lease. Xerox's name for the accounting method under which it made this shift was the margin normalization system. According to the SEC, these two methodologies, which did not comply with GAAP, increased Xerox's equipment revenues by $2.8 billion and its pre-tax earnings by $660 million from 1997 to 2000. The SEC complaint alleged that Xerox failed to disclose its use of these methods, which were changes in accounting methods and changing in accounting estimates. Between 1995 and 2000, Xerox always assumed a 15% return, despite significant volatility in the returns actually earned by leasing companies. Leasing companies discount future cash flows when they recognize the amounts in current income. Discounted future cash flows refer to the present value of the future cash that a company expects to receive or pay. By choosing a particular discount rate, a leasing company can manipulate its reported income. The SEC alleged that Xerox increased its reported earnings by changing estimates of the residual values of its leased assets. KPMG strongly defended its audit work at Xerox. The sale of the receivables to a lender caused the revenue to be recognized immediately and the cash to be received immediately. The non-disclosure of these sales had the dual effects of making the operating income in the period of the sale look better. This in turn made the cash flow situation look stronger. This added $182 million in pre-tax profits to Xerox's 1999 results. The SEC also alleged that Xerox boosted its earnings by creating cookie jar reserves, reserves created by overstating a future liability in one period to release it in a future period, thereby fictitiously implying that the company had less expense in the future period, and then reversing those unneeded reserves back into profits in later periods. The company also improperly disclosed the gain on a one-time event with the result of boosting the appearance of extra profits from ordinary recurring operations. When a company shifts revenues from a stream that should be recognized in a later period in order to have it recognized in a current period, its revenues, operating income, and net income increase, but its cash received does not. Instead, the company's accounts receivable increase. It was later revealed that Xerox had sold approximately $400 million of its accounts receivable. When a company sells its accounts receivable, this increases its reported cash flow from operations. In case the revenue streams are reported separately, and the stream in which revenue is immediately recognized increases in proportion to the streams where revenue recognition is delayed, it is a signal that the company could be shifting revenue to accelerate its recognition. Xerox sold accounts receivable without disclosing it immediately. In such a case, as soon as information is released that a company has factored its accounts receivable, one should realize that this, in itself, could be a signal that the company has accelerated its sales. CUC is presented mainly as an example of improper revenue recognition via reporting fictitious revenue. CUC International, Inc. was a company registered in Delaware that sold club memberships to its customers for automobile, dining, shopping, and travel services. Another Delaware company, HSF Incorporated, controlled franchise brand names in the hotel, real estate brokerage, and car rental industries. These two companies merged in December 1997, taking the name of Cendant Corporation, which carried on the combined activities of the two formerly separate companies. The SEC maintained that the fraud began with the original CUC as far back as 1985 and was allegedly directed by CUC's chairman and CEO, Walter Forbes, from the very beginning. According to SEC records, another pivotal individual involved in the execution of the schemes was Mary Slater Polvera, a CPA who was hired by CUC in December 1995 and became manager of financial reporting in 1997. The SEC maintained that Polvera carried out instructions that included adjustments increasing revenue and decreasing particular expense line items. The manipulation of revenue was accomplished through, among other means, the falsification of sales documents, side agreements with customers that were not recorded, and top-sided adjustments by senior management. Most of the alterations were concentrated on the CompuCard division. The adjustments always increased earnings, and they never had supporting documentation. Clearly, the revenue recognized in this manner was entirely fictitious, with no accounting explanation provided for the entries. The SEC maintained that in April 1998, after the filing of Cendant's annual financial statements, Polvera directed the subsidiaries to give the entries March 1998 effective dates and stated that the entries that would normally be charged to the P&L can be charged directly to retained earnings to avoid opening last year's books. Once again, accounts receivable as a percentage of sales, as captured in such measures as DSO, is a leading signal of this fraud. When examining financial statements, one must be concerned when the reported operating income is not being earned in cash. CUC manipulated membership subscriptions and suspiciously met analyst earnings targets on a regular basis. In a company that sells membership subscriptions, deferred revenue decreasing as a percentage of total revenue is an indication that the company may be aggressively recognizing subscription revenues that will actually be earned only in future periods. This falsely boosts current revenues and earnings at the expense of future periods. When a company precisely meets analyst earnings and revenue expectations quarter after quarter, it is often a sign that things may be too good to be true. Furthermore, when major expense items remain identical quarter after quarter as a percentage of revenues, it is frequently a signal that the reported expenses and revenues are being manipulated. One would expect a fixed expense component to increase as a percentage of revenues when revenues decrease. Likewise, it would be expected that the fixed cost component of an expense would decrease as a percentage of revenues when revenues increase. Insignia is presented here mainly as an example of improper valuation of revenue. Insignia developed and supported cross-platform compatibility software that it generally sold to resellers and to whom it granted certain rights of return. It specialized in software that allowed operators of mobile devices to update and repair them remotely. The SOX Report 2002 listed Insignia Solutions plc as an example of the failure to value revenue properly via providing inadequate allowances for returns. This means that the amount the company has set aside in the income statement to allow for customary returns was insufficient. The SEC found that Insignia Solutions allegedly overstated its revenue and net income and understated its allowance for returns for the first and second quarters of 1996. Insignia had a standard practice of recording an allowance for returns in respect of inventory at resellers that exceeded an estimated 45 days of sales. In effect, Insignia subtracted this allowance from its gross revenue to arrive at revenue. Therefore, if Insignia understated the amount of inventory held by its resellers, this would cause it to understate its allowance for returns and overstate its revenue. The Commission's findings quoted Insignia's own revenue recognition policy as stating that revenue is recognized upon shipment if no significant vendor obligations remain and if collection of the resulting receivables is deemed probable. On February 27, 1997, Insignia announced that it was restating its financial statements for the first two quarters of 1996. Following this announcement, the company's shares fell 35%, from $3.88 per share to $2.53 in one day. The leading sign of an overstatement of sales is when accounts receivable increase as a percentage of sales, which is often measured as days sales outstanding, or DSO. If the next period's sales have been accelerated into the current period, or if the sales are completely fictitious, the company will debit accounts receivable and credit sales as for legitimate sales. However, whereas legitimate sales will be paid relatively soon by the customers and will turn into cash, the next period's sales will probably only be paid next period and will remain on the balance sheet in the current period as accounts receivable instead of turning into cash. The second signal of inappropriately recorded sales is when cash flow from operations lags or falls behind operating income or net income. This is a prime signal. If a company is operating at a profit, why would it not be generating cash flow from operations at a similar pace? If the company separately reports the amount of its allowance for returns, a significant decrease in allowance for returns as a percentage of sales is a signal that the allowance for returns may be understated. And any reference in the financial statements notes to a change in policy regarding the method of recognizing the allowance for returns, or any changes in estimates for returns that lead to decreasing the allowance, should be taken as signals that the company may be understating its returns.